So what we're looking at here again is the basic 14-day free trial to Power Options. Anyone at any time can take a 14-day free trial. Just go to PowerOp.com, enter your name and email address. You'll have full access to the tools for 14 days. And anyone who's currently on your trial, I encourage you to take advantage of the 4 steps here. Get the quick start guide, view a variety of flash tutorials, access our webinar archive and see when our live webinars are coming up. And of course, any trial member or subscriber can schedule a free coaching session at any time. Now, earlier today, I posted a quick video for our Fusion subscribers at the radioactive those who involve Fusion, and Blueprint owners regarding trusting the stock selection as we compared it to other stock selections that were available. And what I mean by that is that on Power Options, if you go into the Married Put screen and you go into search, oops, sorry folks, there we go. You go into the search tool, you see a list of trades that's based on our default criteria as are discussed in the blueprint, the full work that describes the limited risk radioactive trading technique and the 12 different income methods. Now, this is a specific set of option and stock criteria that have worked for us for years. We make subtle changes to this whenever we see a change in the market, if there is a need to change it. And what I mean by that is if there's a different market correction period, a different market cycle, lower volatility, I go back and I take these search criteria that are available here for the defaults and I run it against other potential stock lists. What if I just looked at stocks matching the married put structure, say for S&P 500, NASDAQ 100? What about just stocks that had pure technicals, a certain MACD, Bollinger Band range, or things of that nature? And we compare the stock performance of the stocks that would have matched our default search, the top 3 or 4, against those other positions and see which ones came out on top. And most of the time, it's these default ones which have the better stock performance over the viewed period of time. This most recent one, we looked at an 8-month period from September to May, middle of May. And we looked at from January 2nd of this year, 2019, to May 20th or so of this year. And the stocks that came up at the top of the list at the beginning of each of those search periods performed better than doing NASDAQ 100. I apologize, NASDAQ 100, S&P 5-star, and Platinum list combined, and more. So that webinar is available for Fusion members and Blueprint owners, but a question came in from one of our Blueprint owners here. It says, this is from Mark. He says, I watched the video on trusting the radioactive default screener. Seems you should still look at the chart to validate further down on list might be better. Well, indeed. And of course, you guys are going to receive a follow-up on that, Mark, regarding what if I combined, say, the default, I'm sorry, it's not Mark, it's Jay, but we followed the, if we took this list and analyzed different stock structures, what would the performance be as opposed to just taking the top 2 or 3? So one step at a time. But what that did show, I'll give everyone just a quick view real quick. Oh, I'm sorry. So what we did see, let's scroll through here. There we go. All right. So what we did see, this is just a quick review. The details, of course, are available for members, but taking the top 4 positions for the radioactive search that would have matched on September 6, 2018, and on January 2nd, the top 3 or 4 stocks that matched the search criteria in those days over the 8-month period to 515 was 11.1 for the radioactive screen, those stocks, and 21.4% in that more bullish trend from January 2nd to May 23rd. The NASDAQ didn't meet it. S&P 5-star actually lost in those first 5 months, as did Dow 30 and Value Line lists. And of course, using lists, the technicals one did not perform as well. Just looking at the stocks that matched the criteria on these search dates over the 8-month return, the 5-month return, you can see that the radioactive default criteria that we're using outperformed looking against NASDAQ stocks, S&P 5 stars, using MACD and Bollinger Band technicals alone across the universe of options, Dow 30 lists, and value line stocks. Okay, so that's just the brief summary there, but regarding to that, Jay, we're going to take a look deeper into that and stock briefing as well. Okay, all right. Now, let's get off of this. And go back. Okay, so there we go. All right. Now, second question that comes in is from John. And John says, regarding the most recent trade on radioactive trading, on the Fusion subscription, he says, nice opening on DELL. Further thoughts? Yes. I have an idea of what I'm going to do, John, and I guess it's fair to show it because I'm not giving anything away, because only the Fusion subscribers would have potentially entered that trade with us. No one else would have seen it posted. So let's go to the portfolio. And what I did in the Fusion portfolio the other day, 2 days ago, is we opened sort of a skewed married put position on DELL because it had earnings coming up at the end of the business day yesterday. So on the 30th, after market earnings were released. On 5/29, what we did is we opened 100 shares of DELL at 65.40. At the same time, we bought 2 contracts of the June 67.5 put. Normally in a married put, I just buy 1-to-1, 100 shares in one put. This would have been a risk of about 7.8% for 243 days of insurance. I'm on the wrong one. I'm sorry, that's the June. My apologies, ladies and gentlemen. I'm going to go to the January 67.50. Much better. Okay. So, oh, this is a different entry. I know what my real prices were. My real prices were 65.25 for the stock and 7.80 for the put. That's what we put in to the Fusion subscription. Okay, that looks much better now. And so what did we end up? We didn't do anything today, but that was on the 29th, held it through yesterday. And of course, today we see the stock drop down to 59.25. It was about a 10.3% decrease. At one point, it was down 12%. Now, as John mentioned, this had pretty much the move beyond expectations I was hoping for. I was hoping for 7% down or up, but we got a 10.3 at the close. It was about 10.3% down to 59.25 at the close. A little bit, yeah, about that. So the position right now could be liquidated for a gain. This is at the halfway point on September 25th, this red here. It's not at current. If I go to the portfolio tools again real quick, let's just highlight this. You can see here it's only about 0.4%. The highest liquidation value I saw today was about 1.4%, I believe. It was about $130, I think, maybe a little bit higher. So it's at a profit, but not a great profit. Yes, a simple, I compared a simple straddle and a simple strangle to the radioactive synthetic straddle, but that's not the goal. The goal is, regardless of the outcome of this earnings, this might still be a stock to continue trading, even though the earnings were poor. So, the further thoughts, John. Today's decline on DELL was due to the earnings. In the aftermarket, it was only down about 4%. The decline was further helped, of course, by new discussion on tariffs on Mexico. Okay, I don't think it would have dropped as far today if it wasn't for that as well. The fact that it had earnings that were negative, was going to be down 5 or 6%, and then the new talk of tariffs and weakness in economy, that brought it down the further range to 59.25, I strongly feel. So at this point, I was going to manage it today. And how could I manage this possibly? Well, the first thought was, we got a gain on these puts. We paid $780 for each put, total of $1,560. And as of this was bouncing around today, 1130. It went as high as 1170. But we could sell them now for about 1125. So we've got about a $3.45 gain, roughly 50, well, not quite 50%. It's about 44% on the put options alone. So if I just sold to close these two, where does that leave me? Well, that leaves me with taking in a profit from the puts, still holding a stock that is down, but it leaves me with a cost base of about $58.35 on a stock that's trading at $59.25. So there's our 70, 80, 90 cent gain that we have right now at the midpoint for this particular trade. Now, if I think Dell is still a solid company and that it will recover from this overreaction to the earnings decline, what I may consider doing is coming into October and just buying a 60 put for about $550. I'm not buying two now. I'm only going to buy one and keep it as a standard married put position. Okay, now that's still carrying a risk of 6%. But what do we know that happened today and still might be in existence on Monday? We lost some volatility over the course of the day, but there's still some good prices out there with the stock even at $59.25. So what I may consider doing now, of course, staying shorter in June. This does not offer weeklies. Did give up a lot, didn't it? This earlier today was at 125 when the stock was at 59.50. But I could generate a little bit of premium. Let's say we do the 60 and buy the 65. Okay, so what does that do? Yeah, I'm going to sell a call, which I might give up my shares of stock at 60, but I'm going to buy a 65. Looks like a bear call spread. Why would I do that? Well, it's going to generate $1.30 of premium, cuts the risk down to 2.6%. Remember, that's all the way out to October. And we get that nice little structure where we don't go negative and we still have infinite upside. That's one option, John. That's one option I'm considering doing, shortening the January put into October to give me some time, and then doing our little bear call spread, income method number 6 against it, to further lower that risk and leave the upside open. Now, what's interesting about this structure? Despite the fact that I paid an additional $1,560 to buy two puts to create a synthetic strangle, which the straddle or strangle by itself would have 100% risk of what I invested. If Dell would have only dropped 3 or 4%, and I had been in a standard straddle, the implied, for June, short term, the implied volatility would have gone to close to 0, 0.2, from where it was at 0.4, okay? And the only gain I'd have would be on one of the options based on the move. So if this only dropped from 65, where we were, down to 63, well, my 65 option, the put would have only been worth $2. The call would have been worth about 10 cents. So what happens at that point? I can sell to close it and take in maybe a premium, but the cost to get in would have been closer to $3. Okay, so it's still at a loss. Needed a much bigger movement. Now, because it had a big movement, the natural straddles and strangles were more profitable. But here, with this new structure, I'm in a position that's protected to October that only carries 2.6% of risk, or 162. I still have infinite upside if the stock recovers or starts to move back up over time. And if it stays below 60 for the next 10, 15, 20 days, that works out perfectly. But here's the thing. Remember, I originally got into this stock at 65.25. And although this may seem like a lot of adjustments and a lot of complication, I essentially bought stock at 65.25, where 2 days later, after a 10% decrease in the stock at 59.25, exactly, almost 10%, 6 points down in price, I'm still in a position where I can only lose 2.6% and still have unlimited upside against the position. That's pretty fantastic. And it was done a certain way because they had earnings coming up. That's why I opened it the way we did. Another option, because options, well, they give us options. We know that we just had earnings today, 5:30, so the next earnings are going to be out in August. We don't have a September series. We won't see the August series until after June expiration. But I do have the October series as we used. I'd like to see September, but we're going to stick with October. If I think it's possible that this stock can continue down, that this stock still has more to give up because of the poor earnings performance and more, I could sell those two options, the January 65s we bought, take the profit from those to lower the total cost basis. I don't know if I want to do this yet. I didn't like the prices earlier today, but move that little straddle fence I have down and buy two Octobers. And see, this I don't like. It still carries the 13% risk, but that's if and only if the stock stays right around 60. Problem is, it lowers that lower break even too much, where I'm already near a profit or at a profit right now. Might be a better idea just to leave the current structure I have, or maybe adjust one of these two puts. So anyway, I know that's complicated. I know that went through a lot of material, but again, the structure did what we wanted. John, you'll see an update for me on this soon. Worst case scenario, sounds funny, but the worst case scenario for this particular position we're in right now that's at a small profit, and we can adjust it to take a very limited risk and still have insurance through October at only a 2.5% risk on the position worst case scenario. The worst thing that could happen on Monday is the stock suddenly rebounds and moves back up 10%. It's trading right at about $66, $67.50. That's the worst thing that could happen on Monday. If it moves up another 1 or 2%, I can still make that adjustment I showed you, or a different one. Or if it continues to fall, we can do something even better, or just close the position. So I'm not sure exactly what I want to do that. Yeah, that 6 combined with the movement and then the 3, moving it into October, going from, and the reason that works well is if I want to continue as a married put, is remember, yeah, I paid up front to buy 2, but I'm only going to continue it with 1. So that $3.40 times 2, $6.80, pays for the 1 October put that was around $5.60. The profit that we made on these 2 puts paid for the one that we're in, still lowers our cost basis, and we can still manage it with that 6 that I showed you that doesn't get into trouble in both directions. Okay, so I'm throwing out numbers there. Some of you might not know what those numbers mean. A comment came in, what do you mean by a 3, and what do you mean by a 6? Well, that's all discussed in the blueprint. Those are the terminologies we use for the adjustments against the limited risk married put position. That we discuss here in the blueprint, the full work that describes the radioactive trading setup and the 12 different income methods. And of course, as I mentioned, our Fusion subscribers here at Radioactive Trading can follow the trades that myself and Ernie enter here. And there's the DELL position that was opened the other day, and some of the positions that we're still looking to adjust soon, and Ernie's portfolio as well. Okay, so that takes care of the DELL position from today, the earnings play. Ernie might have actually traded that as a straddle position. I'm not sure if he did or not. I think when he saw me enter the married put there, he said he was going to take a flyer on a few contracts, perhaps on just a straight straddle, and he would have done pretty well on that also. Okay, so that was John. Okay, there we go. Those 2 questions are out as well. Tim, regarding that, it's in regards to that, I should say, Tim says, why not just take the profit and move on? If I was playing that purely as an earnings position, Tim, I would take the profits off the table now and move on. No questions asked. I would have done it either at 10:30 this morning when it was down about where it ended today, 10.3%. Let's just go to DELL real quick. Let's go to the stock quotes page. Okay. So yeah, we're down 10.3%, 686. Okay. I entered this as a married put because I looked at the stock chart and I've seen that there have been times in the past 2 years where DELL has seen an 8, 10 or 12% decline and has recovered from it very quickly. Very rarely does it have this decline around earnings and stay down over the past few years. So let's take a look at big charts real quick. And I'm going to go to that 2-year chart, and I'm going to remove some of this information here so it's not all in our way. Yeah, I'll leave that there for now. Let's just go none. Sorry, guys. Just customizing big charts here for our needs. And okay. Now, this is going to be a close chart. It's not going to be big. Now, see, look here. Here you can see some of the big declines that it's had, and these were all due to earnings. I was looking at this. There's the big one there. There's the other one there, and then, of course, the one today. And, yeah, this was related to also the market declining through the October and November of 2018. But look, it was mostly holding still in there, and it was waiting for the earnings, and then it really got trounced. And then it's just come back up. Okay, now, it's hard to gauge on that. Right? But at the same time, although it takes some time to recover, once there is that dip, and there might be even, like you see here, there might be even a little bit further dip in the days to come, which works out perfectly for what position we're already in. But as it starts to rebound, I might be able to get into a profit or 4 months down the road, 3 months down the road before October, if it starts to do this again, guess what? I'd have a completely bulletproof position still with unlimited upside with a cost basis of $59.25 with a stock potentially trading around 68 or 70. Optimistic view, I admit it. But again, it usually seems that this company tends to recover after large earnings upsets or misses. So, although I could just take that profit now, but if it was just a pure earnings speculation play, I would have entered this as a standard long straddle and probably bought the June 65s when the stock was at 65.25. Bought a June 65 call and 65 put, or maybe even the 67.5s as well. But this was designed to, I'm not sure how good or bad earnings are going to be, but I expect it to have a move of at least over 6%. And I think it's a decent company to be in, even with the talk of tariffs and more. I could be wrong on that, but by entering into that married put position and skewing it slightly in my favor, I was able to withstand this 10% drop. As you saw, I'll be able to adjust the position to have a small risk and still be protected out to October, but continue to trade it for further upside gains and do adjustments such as the income methods we talked about to generate income and further lower the risk as more. So that's my long-term play. And you're right, Tim. If I wanted just to do it as a straightforward earnings play, I would have done it as a long straddle, as Ernie talks about in his long straddle video that's under the long straddle strategy. Let me get that for you real quick. All right, so let me add long straddle to our configuration here. Yeah, this introduction to straddles part 1, sort of the theory that Ernie's working on now, and part 2 and part 3 will be coming out eventually. But it discusses his approach to earning straddles, what worked, what hasn't worked, time frames that worked, entry positions, exit time frames, and a lot more. All right. Okay, so we're essentially at about 4:58 p.m. Eastern Time. I want to remind everyone, of course, you can send in any questions at any time during the webinar related to any concepts of different options trades, options concepts, and more. I'm going to change strategies again real quick here. And I'm just going to let... we noticed something recently. A couple customers brought it to my attention that some of the default searches weren't producing a lot of results on a consistent basis. And I was wondering why. And then it dawned on me. And the main one, of course, is the Iron Condor position. And both the weekly search and what we call the monthly search or the initial values search for Iron Condors were sometimes not displaying a lot of results. Maybe less than 4 or 5, and then sometimes you might not see anything. Oh, that's a fake. That's something we did in a webinar. So I'm just going here because I want to show you that we made some adjustments to the weekly Iron Condor screen. One of the issues was back about a year and a half ago, shortly after February 5th through 9th, and shortly around that March 21st to April 5th decline of 2018, the Iron Condor screen was showing up to 400, 350 results. Our default screen wasn't too useful because the implied volatility was too high, which might be a great time to sell Iron Condors, right? But it's counterintuitive. If implied volatility is high, you hope it drops back down, right? You hope that it reaches its peak, the VIX reaches its peak, and that it'll settle down. And as it pulls down, the option premium is lower. And that's a great place to be selling on both sides if you feel the market is neutral. Problem was the market wasn't really neutral. It was bouncing all over the place, and that's not the position you want to be in an Iron Condor. You want a much more stable market. Long story short, to limit the number of results, we decided to go, hey, why don't we go for the best probability between we can and go further out of the money on both legs of the particular position. So we were looking for positions that were maybe 10, 12, 15% out of the money. What do I mean by that? An Iron Condor, we're doing a bull put and a bear call credit spread on the same stock. You want the short option, the trigger point, to be pretty far out of the money, or at a point where you don't think the stock is likely to drop below or rise above. So we were looking at these to be going 10, 15% out of the money, even on a weekly series. And last year, probably all the way up until September, but then in October it started again because volatility shot right back up. We were seeing a lot of results. Now that the volatility has settled, despite what's happened in the past, we saw a recent volatility spike about 3-4 weeks ago. I first mentioned the new China tariffs, I should say. But what had happened is that now that volatility has eased back a little bit, there were only 2 or 3 positions at weekly options that were at least, the short call and short put, I should say, were at least 10% out of the money or more, still offered a good net credit and a good probability. So based on that, we made some adjustments to the screening criteria. We eased off the range out of the money for the weekly Iron Condors, lowered the restriction for the net credit to allow more results, but at the same time forced that probability between to be up as high as 75%. And we see the results we'd kind of expect, right? Most of the Iron Condors that we would look for would be on higher price positions, stocks in the $200, $300 range, $150, $160, some lower price stocks which you might not consider. But even with a 2 to 10 day time period, we're looking at Iron Condors with some good double-digit returns and a good probability between. But what is the problem with a good probability between? As we saw today, and I had a couple customers call me today for discussions on these scenarios. Everything was all well and good. A few customers I talked to today had Iron Condors that yesterday were still between the strike prices, looking to expire worthless. They had opened on Monday or possibly Tuesday. A few bull put spread traders I talked to had opened positions a week or a week and a half ago. We're coming up to the May 30th expiration, this week's expiration. On Thursday night, looking really, really good. Still around 2 to 3% out of the money. They could buy it back for a 90% gain, and then boom. As always happens, some news comes out after the market, and there we go. Now we're stuck in a position where we thought we had another 4, 5, 6 points to move in one day. Otherwise, all 4 of our options in the Condor would expire worthless. Here we are within 0.5% or below our short put strike price because of the movement in the market today, and things may now have to be adjusted. So the probability is great. And the probability is what I want to use. I always use going forward for my vertical spreads. But again, any news that comes out, any unexpected event, someone launching missiles into the ocean, someone saber rattling across the pond, anything of that nature can cause a sudden movement where the probability is affected in that situation. The probability, of course, is just like delta. It's based on if nothing else happens out of the ordinary over the next X period, what do you expect your success rate to be, or what do you expect the option price to move to? The minute something happens that's unexpected and volatility spikes, the delta and everything else naturally will change. The markets will react, and what looked like a very successful trade now needs to be managed as well. Okay, so I just wanted to include that about the Iron Condors and some of the adjustments on the search criteria. But remember, the important thing about Power Options and any search, this is our default to give you some ideas of what Ernie and I would consider a likely position that we would enter. It's not a recommendation directly, but this is what we would consider doing going forward. What we would consider if we were opening an Iron Condor today. As Jay mentioned earlier, yeah, of course, we're going to go ahead and look at the stock chart, make sure it's something comfortable for an Iron Condor position. But even though these are our defaults, if you're not comfortable with this range out of the money for even a 7-day trade or a 10-day trade, you'd be more comfortable being 7% out of the money for your short call or short put. All you have to do is make your changes, submit the search. You're going to narrow down that universe. Nice list of only 9 results: Win, Twilio, Roku. I wouldn't touch Tesla as an Iron Condor right now. Not sure if I'd touch NVIDIA. Again, I can't speculate for you. But this narrows it down to lists of condors with good returns, with good probability for a 7-day trade. You can adjust this how you want to make it match your specific needs with just a couple clicks of the mouse. All right, but that's just an update for you Iron Condor traders who use Power Options to identify your screens and who use the default searches, the initial values, or our weekly ones as well. Okay. All right, so John says, thanks, Mike. We'll catch the rest on the recording. Like the stock selection video I saw today, I gained confidence in the married put strategy from that video. Fantastic. All right, Fernando, do you think that is option market that move on the stock price or the stock markets itself that move the price? Okay, this is a tough question to answer. What Fernando's asking is, can a high contract size, a high contract trade one direction or the other, influence the price of the stock itself? Or is the stock markets that are moving the underlying stock price? Most of it is by far the stock markets, Fernando, if I'm understanding your question directly. The options and what you might consider the futures when you look forward to the morning. You know, first thing I looked at this morning, regarding the markets is that there's an article in Bloomberg and an article in Forbes. You know, quick little stock app, open it up. What's the news on, say, SPY? First thing I see, Dow poised to open down 215 based on the futures prices. That's not related to the stock options and the security options per se directly. Okay, what that means is that people who are trading the Forex are projecting there's going to be a strong decline in the market, and their projection was it was going to be 215, and they're buying futures contracts at that lower strike price, 215 down on the Dow, 80 or 90 down on SPY, along those lines, okay? And SGX wasn't even that bad at one point. So I'm not going to say that it's the options. But then again, there is some speculation, or there is some occurrences where you might see a large contract opening. Look at top stock losers, ex dividends, earnings. One of the pods we show, or we did show, I'm sorry, maybe I already have it here, I just can't find it. Oh, no, it's in a different position. I'm sorry. Let's go to Learning Center. And I'm going to go to market activity. And then from there, not that, market statistics. Yeah, I went to the market statistics. I apologize. Okay. So we used to show this as a pod, but we took it off. And the reason why we took it off is because most of the time, it's different, of course, today, as I mentioned it. But most of the time, it was the same 2 or 3 securities you'd see in this list every day. The highest contracts, highest volume options, yeah, it's going to be an SPY. HYG is interesting, and JCI, those are kind of interesting. This makes sense here. The highest open interest, EEM, right? Those are the earth elements, right? If I'm not mistaken, the ETF for the earth elements, which of course is in play now because what China said it might restrict those as well. And the VIX is showing a huge number of contracts. Of course. We saw a general move back up in the VIX, back to 1845 today with a spike in the movement. So people are using that as a portfolio hedge or guessing that it'll settle back down within the next few days. And you'll take some premium off of that position. Okay. And these were the calls. So people are probably, oh, I see it. Yeah. Market hedge, portfolio hedge, buying the out of the money June 25 calls, which were probably under $1 with a spike today, fearing that the volatility index might go up to 25. I can imagine they'd be selling them, although if the premium was enriched and it's 7 points out of the money, they might be trying that too. But for a buyer, there's a seller. So did any of this movement drive the volatility index? No, because it's not a real security in the sense you're talking about. Okay, what's driving SPY? Well, it's puts and calls. Okay, the May 31st today 277 calls, people might have been selling those while buying the 277.5 puts. What's pretty interesting here, Fernando, and you can't see it because my drawing skewed everything. What's pretty interesting here is that the number of puts that were bought at the 275 strike, 182,907. Now, there's a mix there. Okay, it's buying and selling to be fair. Is about 50,000 contracts higher than the calls. Well, I see this and I might consider it as a protective collar, that investors are looking to hedge large portions of SPY by buying the 275 put and selling the 277 call as it fell there to try to get into a collar protection on their SPY if their price is maybe at around 280 or higher and then the sudden spike down today. Or it could be a straddle position. Be interesting, wouldn't it? If it recovers back up, hey, great. If it keeps going down, we're good. But since it was the 31st of May where the largest contracts were, what else did it tell us? People were closing, rolling, and adjusting those positions that expired today. That's pretty much the reality, isn't it? Okay. So you get a lot of emails, Fernando, and a lot of you probably do. You subscribe to different things. You may have opted in to different emails from your brokerage accounts or from your trading account, for example, that show you information on the largest open interest today, the biggest movements. There's an email that I receive that's related to the term options, and 90% of the time it's a service that's saying, hey, I think the other one yesterday was CHK shows unusual option volume for the June series. It doesn't say calls or puts. It doesn't say what strikes, just an increase in open interest. Did that drive the price up or down? Well, there is more of a demand at a particular strike price now, but it's much harder to insinuate that the larger option contracts, 10, 15, 20, maybe even 100,000 contracts open, would drive the market in the direction. But again, it's probably going to do some driving of the market, but not nearly as much as the outside conditions as well. Why do I say it's driving some part of it? If someone comes in and does a large lump at a particular strike that seems out of the ordinary, what are the two things that have to happen? Well, number one, we have to have sellers for buyers. So Trader Joe comes in. I shouldn't have written this out, but I'll just write Trader Joe. Comes in and he wants to do something crazy. He wants to just buy 30,000 contracts of a July 20 call on stock ON, the ON semiconductor security. I'm just using that as an example because it's one I trade. Well, to get filled on these 30,000, what does he have to have? What does the market maker have to have? He's got to have the other side. Right? He's got to find sellers willing to sell the July 20 strike call and the stock trading at 1850 and sort of fill 30,000 contracts so they're not on the hook. Okay, so what does he have to do? He has to make the price appealing. Now, here's a problem. The more he makes the price appealing for the sellers, so he gets sellers to come in to get filled at the price, and this is more of an older day view. A lot of this is done by computers now. The less likely Trader Joe is going to like the price that he's going to see to get filled as 30,000 when he put in his initial order. Okay, but let's say by some miracle, some strange miracle, this is filled. 30,000 contracts at the July 20 strike on an $18 stock are purchased, and counters are sold because the stock has to be gone long and short in between to cover the obligations of assignment or exercise, right? We all know that. That's sort of the basic tenets of what goes on in the background here. Now, why do I say this is an absolutely ridiculous position to even discuss? Because ON, not only the fact it is an $18 stock. Oh, I didn't want to go to the chain. I'm sorry. But on average, the normal put volume in open interest is 204 contracts across all expirations. And the total open interest across all expirations is good. It's about 90,000. Okay, so but he's trying to do a third of that on one particular strike. So what is that going to create? Well, it does create something. I'm sorry, the stock's at 1776. It does create something, doesn't it? Now there's the 30,000 call contracts looking to be bought, and he has to find a match. There has to be a match to sell to make it a fair market. So that's 60,000 contracts that might be opened in one day, some buyers, some sellers. It's got to appeal to both the buyer and the seller. But when you pretty much almost match or get 2/3 of the existing open interest in one trade or in one day of trading even, the market's going to look at that and say, what's going on? Who's betting on what? And is it worth the bet to take with the stock or with the option? Or, hey, should I get out of my position now because someone's speculating? So that might encourage more stock volume because, again, with the coverage of the short calls, as I mentioned, the market maker, that those computers have to generate long and short stock positions to sort of make a match between the long and short options. And that could drive the price, but it is sort of a wash, isn't it? They're sort of negating one another, but it might drive other speculation and other fear with that big of a size, which might lead to other investors speculating on buying the stock or selling the stock, I should say shorting the stock, Fernando, which may move the stock. Or everyone might just sit back and say, I don't know what this Looney Tune is doing. I don't know who the Looney Tunes on the other side of the selling the calls to fill it. I'm just going to step back and watch what this does by July expiration, see if anyone wins on that trade or if someone's going to lose a lot of money buying 30,000 calls they have no business buying. And that might not be the most educated answer to your question. I don't have the data to support that fully one way or the other. But that is my understanding of how things will go. And yes, I know, just slipped my mind. Najarian. On CNBC now. I forget where his is, or just NBC Business, CNBC, I guess, in the morning. He was doing an option screener, and I think he still has it. And what it does only is it looks for a heat map, I think they call it. And it's targeting options or stocks that show a significant increase in just open interest and volume in the quote-unquote heat of the moment. Okay, so it's looking for where is the hot action, where is this going? That doesn't tell you if it's moving up or down necessarily. You can see that there's a lot of activity on the calls, but if it's a lot of activity on the calls, that means there are buyers and sellers to make it an even pool of in and out. So who's really speculating? And by the way, and I think their tool may or may not show this, I don't know, but a lot of times when you see, let's say, 40,000 contracts at a particular strike, which is more than double the current volume or open interest for that strike price, you've got to check the other strike prices around it, or even ones maybe 2 or 3 months out, because that tells you what? Well, let's go back to ON, and let's now look at the chain. And let's look at July and just the calls. Okay, so that 20 strike call I was just using as an example only has an open interest of 364. So if those fictional 30,000 contracts would have been open today, that's like 100-fold, more than that. Okay, so it jumped up to 30,000 open interest and volume instead of just 9 contracts. And you say, oh, okay, well, if which you don't even know, of course, was that buying or selling. But let's say you did find out that I was a buy. The initial order was put in as a buy, and you say, oh, this guy is going bullish on this stock all in. But now you go to June, and you see that something weird happened here. Someone also opened 29,000 calls at 18. Oh no, that's interesting, isn't it? What would that be? That'd be a bearish calendar spread where they're telling you they're not going full bull. They're hedging maybe a potential longer term bet by saying they're very confident the stock is not going to go above 18 in the next 21 days. This is not an all bull in move at all. This is a bearish spread, a bearish calendar spread where they're saying that 29,000 and 30,000 contracts are wanting to believe the stock's moving down, not up. That's an interesting take, isn't it? Of course, the reverse might be true too. You might see them buy a bunch of 20 strikes and then selling a bunch of 23 strikes. Well, that's still a bullish move, but they're doing a bull call debit spread as opposed to just a straight long call. You've got to know what the other ones are around you. A lot of times on SPY, I do get this from time to time, Fernando. I'll have a customer call in and say, hey, I just saw, oh, let's take it as an example. Oh, we can't use that example. That's not the one I wanted. But we'll use it anyway. I'll go to SPY. Actually, we'll just do it here. I'm going to look at the same chain. All right. And we saw those huge, at the money strikes, right? Was it? Oh, yeah, here it is. The 280, 28,000. These numbers are all over the place, from 0 contracts in open interest and volume today. Oh, there's a lot of volume. But from zeros and 2,000s up to 32,000s, 18,000s, 500, 22. You know, they're all over the map here, in the money and out of the money. Now, you see this jump up today. We saw that 280 call with 28,000 open interest. Okay, it's most likely people closing positions that expired today. Now, what you need to do is say, okay, well, we need to go, what's the next series? It's on Monday. I don't trade SPY this way. I applaud those of you who do. But see, there's nothing. Well, see, here's volume. 10,000 contracts at 279, 14,000 at 280. And that's just for Monday's expiration. Can I infer that the 28,000 contracts we saw today in that movement, were people trading it today, or people closing positions to move out to the next expiration and betting on different strike prices? Truth is, I don't really know. Okay? But when you see a large jump that stands out from you on a particular stock, you want to look at the other expirations and see if there's almost a similar number that's spread out over different expirations or different strikes in those expirations, so you can see someone's building a staggered bull call debit spread. It's not really just a long call. Or someone is building a staggered bear call credit spread. They're not bullish at all. And that's kind of interesting to look at sometimes because it throws you off. When you see a high open interest or a high volume that seems out of the blue for a call strike on a particular stock, does not mean it's necessarily a bullish play. It could be a calendar that's staggered to be bearish, or a straight calendar that's bearish. Bearish in the short term, and maybe longer term bullish after the short event. So that's how that kind of looks. So Fernando, to answer your question, it can drive the markets, but the market prices more are driving your changes in the option premiums and the options data, as opposed to the options buying and selling changing the stock prices, in my opinion. Anyone who has a thought on that or has specific proof that I'm completely wrong in the comments I just mentioned to Fernando, as always, comment on the video and let me know. Because if I'm wrong, I want to know it. If you have better insight and better statistics to tell me that I'm right or I'm wrong, I want to know it right off the bat. All right. Well, ladies and gentlemen, it is 5:24 p.m. Eastern Time. If anyone has any further questions as well, go ahead and send those to us. Fernando's comment and say, okay, thank you for your sharp read of the chain. Yeah, it's always important to me that because I see it sometimes on a stock that I'm in. You know, sometime a few months ago, I saw one of those emails that said option volume for July Trex puts is higher than average. And I looked at it, and it wasn't a straight put buy, but it was still a bearish play. They had bought July puts, and this was back in, no, it was probably in May. It was probably a few weeks ago. But they had bought July puts on Trex, but they had sold shorter term May and shorter term June puts that almost equaled the same number of contracts against it at lower strikes. So it was actually sort of a bear put debit spread in that case. They were doing calendar bear puts. There was a bearish bet in that case. Okay. This is a question I'm going to dodge, and I'm not going to dodge it to be rude or a jerk, but I'm going to dodge it because I'm going to be honest with you. I'm not sure. This comes in from S. S just asks, you clearly do your homework. What is a good trade setup for Monday? I don't know. I can't answer that question. And exactly, I don't know if you're here at the beginning of the presentation, but we talked about that married put position I had that, well, it's not really a married put position. It's following the married put techniques that we use. But I opened it as a ratio, a 2-to-1, to give me a synthetic straddle with earnings coming out. And the stock was at 65.25 when I got it, did the 67.5 puts, and here we are down at 59.55. Now, at the beginning of the presentation, John asked, who's a Fusion subscriber who follows our trades there at Radioactive Trading, he asked about what are my plans to manage. And I showed him the two plans I might consider. Well, that's also based on Monday, if the market opens down, if the market opens down, I may not do anything and just let it run. But if it moves up, I'm going to do a completely different adjustment. So any position I would open right now with uncertainty would probably be a straightforward married put position, or it would be a standard collar position where I'm using stock on something I'm bullish on, but I have a very low risk going in, 3, 4, 5%. If I'm longer term bullish on the stock, even with the market hesitations here, I'd probably do a married put. If I'm shorter term, want some good premium on this volatility, I'm going to do a collar. I'm likely not opening any bull put credit spreads or even bear call credit spreads, planning on opening anything on Monday because I'm going to see what the market does after today and what happens on Monday. I'm not going to force myself into a trade just to say, hey, I want to make a trade today. I want to see how the market's going to further react to the news that came out today, the threat of more tariffs, or what else happens over the weekend. Usually my new positions on Monday, I won't open till after 2 or 3 o'clock p.m. Eastern time. I don't open anything in the morning usually. I'll adjust positions in the morning that I already have open, but I won't open any new positions right away. I'll usually wait till probably closer to 2 o'clock in the afternoon. Now, I've done research during the day and I've decided what I'm going to do, but I want to open it around 2 or 3 o'clock so that the volatility has sort of been pulled out. We get a gauge if the market's feeling stable or not. But in uncertainty, anything I'd open would be a limited risk. And you can say, oh, a bull put credit spread is limited risk. Well, it's not limited risk. Buying a call is not limited risk. They are known risks. You know the maximum amount you can lose in each of those positions. That is true. But you're also risking 100% of whatever you invest in that position. And if you use the leverage too much, and you buy too many calls, or you buy too many contracts for the credit spread itself, where you're risking 5, 8, maybe 10% of your portfolio in that one position, that is not a low risk trade anymore. That's a highly leveraged position that could wipe out 10% of portfolio in a sudden event when the market moves against your expectations. Before you know it, you could be at a 70, 80, or 90% loss. You just wiped out 10% of your portfolio. That's the danger. Leverage works both ways. The lie of leverage is what they call it. So, what am I going to open on Monday? I won't know until probably around 12, 12:30. And if I do open anything on Monday, I'm probably not going to open it until 2 or 3 o'clock Eastern time. Okay? And it'll probably be a 2-week out trade if I'm doing a credit spread. Might do a calendar or a double diagonal as a potential as well. If the volatility settles, buying a straddle on, say, SPY or strangle an SPX with very low commitment, so it represents a low portion of your portfolio, might be an interesting one because we're not sure if we're going to continue to see downdraft or we're going to continue to pop up. And so that's just where I stand on that. That's just my general thoughts on that idea of what is a good position to open on Monday. I'm not really sure yet. I have my ideas. You probably already gathered that I have ideas of what I might do if I was opening a position, but I want to wait to see what happens in the morning, wait to see what happens over the weekend before I say, you know what? I think a calendar call spread on Amazon would be a great position to open on Monday. Let me put in the order with my limit prices for my broker and have it set to go as soon as the market opens at 9:30. Well, if more bad news comes out over the weekend, or something bad comes out on Amazon, my sentiment might change by 9:40 in the morning, 9:20, 8:30 in the morning, 7:15 in the morning. My sentiment might have already changed. That would give me time to cancel the order, of course. But again, that's all I'm saying there is that I don't have, if nothing else happens over the weekend. Oh, all right, I'll go out on a limb here. And I can be wrong, 50-50 shot, right? If nothing else unexpected happens over the weekend, no poor financial news or financial speculation happens over the weekend, I expect Monday we'll see easing of volatility and an increase in SPY and the broad market. Are we going to gain back what we lost today? No. Are we going to gain half of it back? Maybe not. Probably not. But we're going to see a little bit move of an uptick as people sort of settle down and calm down a little bit. Again, if there's no other announcement, speculation, saber rattling, threatening, more tariffs introduced, more talk of tariffs come out of specific things that are going to hurt one direction or the other, then I'd expect SPY and the broad market to ease off, volatility to drop a little bit, come back up as well. Okay. Fernando just offers in. He says on Monday he's probably going to open a calendar put spread on VMware. Okay, that's an interesting one. Calendar put spread, of course, betting bearish on the position, but generating some premium to lower the cost. VMware, I'm assuming, is going to be affected by the tariffs, perhaps, or maybe even the rare earth elements in reverse there, depending on. I don't know if they make their actual own manufacture, I should say, their own components using the earth elements, but that semiconductor sector, VMware, and the programming sector could be very interesting effect, as is my ON position. I know John's waiting for you to make an adjustment on, but ON Semiconductors, I don't have it here, but that's the one that's at 1776. I bought the stock, I think, at $22 or $23, and I've got the 25 put. Now, I'm at a loss of about, 7%, 6.8% on it. I haven't adjusted it yet because it hasn't hit the bottom, but I haven't added another put yet because I'm not confident it's going to drop much further from here. So I'm waiting. I have the ability to wait because the put's out to January, but I'm not trying to overreact with the market just yet and put in more cost to a position where I'm not clear when it's going to bottom and what it's going to do after it bottoms. As we talked last week, John, I almost thought it was at the bottom, and it clearly wasn't. So that's something I want to look out for. All right. Well, ladies and gentlemen, I just want to, of course, remind everyone that, sorry about that. Oh, it always does that to me when I don't want to. I want to remind everyone, of course, that today's material is my thoughts on your questions, designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or suggestions. Again, but options do involve risk, may not be suitable for all investors. If you choose to do leverage positions, I encourage you to make sure that those leverage positions, the known risk of a long call, long put, bull put, bear call, credit spread, or even a debit spread, is a known risk, but if you overtrade the contract size, it's not necessarily a low risk because you'll be taking on too much risk in your portfolio. If it suddenly moves against you, you don't want to overtrade those positions. So may not be suitable for all investors, of course. If you like what you saw today with some of the tools, we touched on the search capability, the Iron Condors, the portfolio tools for tracking, of course. We looked at some of the market activity pages, and as Fernando mentioned, we walked through the chain a little bit to show you how you could navigate through that to see sort of comparisons between different months, open interest, deltas, gammas, thetas, all of that. But if you're interested in the tools, remember you can take a 14-day free trial at any time Just go to PowerOpt.com, put in your first, last name, and email address, and you'll get full access to the tools for 14 days. After that, the subscription levels start at $45 per month. We do offer a delayed service, of course, and a real-time data service. You do pay extra for that for the subscription, but you don't need an extra data feed. That's all included because you're interacting with our servers. Want to check out other free education over the weekend? Go to the blog at any time, blog.poweropt.com. You can also go to our webinars page we mentioned earlier. It's poweropt.com/webinars.asp. You know, check us out on YouTube. Just go to YouTube and look under Power Options, and you'll see a lot of our archive videos there as well. Now, if you think of a question later on this weekend or at any time, remember you can always send me an email to support@poweropt.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, trial members and subscribers, I encourage you to schedule a coaching session. Remember, that's a 35 or 45-minute phone conversation with myself or Ernie. You can have as many sessions as you want as a trial or subscriber. We'll walk you through the tools on the site, answer any questions that you have, just as we did today, the same type of format. Ladies and gentlemen, thank you once again for your time. Have a fantastic remainder of your Friday evening, and I hope you have a fantastic weekend, and we'll see you next week. It almost seems weird to say, but starting the 6th month, June trading month of 2019, we're pretty much already halfway through the year. It seems strange, but here we are. So we'll see what the rest of the 2019 has in store for us starting on Monday. Take care, everyone. See you soon. Goodbye.